Hi to all the Cubs of Wall Street. Welcome to Introduction to Stock Analysis. Today we're going to go over what different types of stocks exist, some different types of investing, and what approaches you can take to the market. We're also going to go over fundamental analysis, industry analysis, brokerages, and finally, meme stocks.
All right, so types of stocks. The main categories are blue chip stocks, penny stocks, growth stocks, income stocks, and speculative stocks. So let's start with blue chip stocks. These are the stocks that are usually large and stable companies with a long history of stable earnings, and usually they pay out dividends. They have very low potential for high growth due to their establishment and large size. And these are typified by most of the stocks you see in the Dow Jones Industrial Average. Some examples include General Electric, IBM, British Petroleum, and so on. Now, the exact opposite, penny stocks. These stocks are valued at $5 per share or less, and they're stocks of a small public company. And they aren't usually traded on large stock exchanges like the New York Stock Exchange, but instead over-the-counter transactions. Now, growth stocks. So companies that are considered growth companies reinvest most of their earnings into their business instead of paying out dividends. These companies usually have a high price to earnings ratio because investors expect significant growth in the future. And investors like these stocks because they can return more on a shareholder's equity than if the earnings were paid out as dividends. Basically, the increase in stock price due to the reinvestment in the business can outweigh what an investor would make from dividends, making this type of stock very attractive. This, however, does not come without an element of risk, because if the company doesn't grow as fast as anticipated, the stock price will plummet, even if they are still profitable or maintaining stable earnings. Income stocks. So these are stocks that pay out high dividends, and they're usually blue chip companies. And so unlike bonds, the amount you get paid out grows year after year if the company's earnings grow. And a good example of this would be General Electric. And finally, speculative stocks. So these are very small companies that have little to no earnings, but they have very high potential to grow. So these could be companies tapping into a new market or developing some revolutionary technology. So a good example of this would be Apple in the like 80s with computers, or Microsoft back in the early days, where they're developing a new technology. And as we saw, the investors who invested in that definitely made a lot of money, since those are now some of the biggest companies.
One quote we wanted to add is, an important key to investing is to remember that stocks are not lottery tickets. It was made by Peter Lynch, and it holds ever true now in the age of meme stocks and really high speculative growth, especially what we've seen over the last couple of years.
Okay, now let's move on to the different types of investing and the different ways that you can invest. So there are many strategies that you can use to invest. So the central principle to a lot of investing is to avoid risk. You can do this through diversification. You should always do your proper research and base your investment on solid fundamentals. Now, there are some different branches of trading, such as active investing, trading, and passive investing. Now, active investing, you're trying to outperform the markets and you're keeping track of your investments. You're actively changing your investments so that you can outperform the markets. In passive investing, however, you're trying to make stable and safe investments. You're leaving your portfolio alone and hoping that it will grow in the future by itself. Trading is attempting to time the market and its short-term movements. There are some different types of stocks as well, such as small caps, mid caps, and large caps that people can invest in. Small caps have a market cap below 2 billion USD and usually move faster than large caps, which have market caps over 10 billion USD. In the middle, there are mid caps. Okay, day trading is usually what professionals and experienced traders do. Day trading is buying and selling stocks during the same trading day. So an example would be buying Apple stock in the morning and selling it sometime before the market closes. Usually only highly experienced and educated investors and traders are able to make a profit day trading because there's an immense risk and a huge potential for losses while day trading. Day traders pay constant attention to the markets and the stocks they trade, usually by the second. The PDT rule is another major danger when day trading because it puts many restrictions to prevent excessive day trading. Beginners should not try to day trade with real money, and normal investors should not try to day trade until they have a lot of experience. Fixed income investing usually relies on bonds. So what are bonds? Bonds just through many, but not all brokerages. After purchase, a bond returns a fixed income every year called a yield, which is why it's called fixed income investing. There are several types of bonds, but the most popular are corporate, municipal, and treasury bonds. So what are the benefits of bonds? Bonds are seen as safe havens because they're safe from stock market crashes. When the stock market goes down, bonds go up because bonds are usually seen as much safer than stocks during volatile times such as a market crash. Bonds offer a fixed income percentage or a yield on the investment every year. Bonds are often used by companies and governments to raise funds. What is commodity investing? A commodity is a resource or a raw material, such as cocoa, cotton, oil, gasoline, heating oil, coffee, and even orange juice. There are many ways to invest in commodities. You could buy the real product, such as physical gold or silver, or you could invest in an exchange-traded fund on the stock market for the commodity. For example, SLV is a popular ETF that you can use to track silver prices. Another type of investing is real estate investing. Real estate investing is based on properties and land going up in value. Properties can go up in value if people move there or if it becomes a better place to live. This is based on supply and demand. For example, if a location has more opportunities, if there are more jobs, if people are moving there, the values of the properties there will go up. And that's what real estate investors try to capitalize on. So how do you invest in real estate? You could buy a real estate investment trust or a REIT on the stock market, or you could actually buy real physical property such as a house or a land. There's another type of investing that a lot of people do, mostly inexperienced people, gambling. So some people with high risk tolerance gamble on stocks that they usually know nothing about and they hope will skyrocket based on no valid information. Most of the time, gamblers will lose a lot of their money, but similarly to real gambling, people sometimes make money in very, very rare cases. But usually these are the only cases that people actually see. The losses are usually never posted publicly, making gambling seem a lot more appealing than it actually is. Here you can see a lot of the losses that come with gambling, but in very rare cases, there's also a gain.
At InvestRight, we want to strongly discourage from any type of investing where you do not know anything about the stock and you're just hoping that it'll skyrocket. Even if every single person you know is recommending a stock to you, we encourage you to do your own research and figure out whether this is really worth investing in, because you don't want to end up losing your money and you don't want anybody else to influence you to lose money. And that's kind of, honestly, it becomes some of the worst feeling you can get when someone just tells you to invest in something and you just lose all your money in it. Next, we'll go over fundamental analysis. So what is the goal of fundamentals and fundamental analysis? It's all based on determining the intrinsic value of a stock. The intrinsic value is the fair and unbiased value without speculation of a company. And with fundamentals, we can use them to analyze the business or security, and we can study the factors that affect the value of it. So with fundamentals, when you're studying them, you generally use them to look at stocks with respect to themselves, their industry, and the economy. Remember, fundamentals, even though we use them in the context of stocks here, they're not just limited to stocks. Options, Forex, and cryptocurrencies like Bitcoin all have their own fundamentals and different methods of fundamental analysis. Fundamental analysis is very different from technical analysis. While in fundamental analysis, you base your research off of one, research, and two, company events or company news Technical analysis relies purely on charts, and it is almost akin to speculative trading and speculative research. So one of the first methods you can use to perform fundamental analysis on companies is called the SWOT structure. So this simply stands for strengths, weaknesses, opportunities, and threats. And this analysis is just an outlining process. So this method, it was created in the 1960s by Albert Humphrey of the Stanford Research Institute during a study to kind of conduct inference on why corporate planning failed consistently. So figuring out the strengths, weaknesses, opportunities, and threats of a business allows an investor to see where a company is positioned in their industry and sector. And it also allows the investor to decide whether or not a company would be worth investing in, because it helps them lay out all the facts. Next, another optional model you can use is McKinsey's 7's. This model was developed in the late 1970s by former consultants at the financial services company McKinsey. They identified 7 internal elements of an organization that need to align and work together for it to be successful. So let's look at each of the elements individually. The first one is strategy, and this is the company's plan for building and maintaining an advantage over its competitors. So for example, Apple's plan might just simply be build the best iPhone, put as much money into research to build the best iPhone. Structure, so this is how the company is organized, what departments are in, how its teams are structured, and this is a very intrinsic metric. Next is systems. Going along with structure, this is the daily activities and the procedures that the staff use to get their jobs done. Next is shared values. These are values to the core of the organization, and it's kind of shown through in its corporate culture and its work ethic. So companies like a Google, one of their shared values might just be working really hard, because all of them, they want to put out the best browser, they want to put out the best products possible. Next is style, and this is simply the style of leadership that the CEOs, the board, and the executive team adopt to control the company. And lastly would be the staff and the skills. So this would be the employees and their skills and capabilities to help run the company. So McKinsey 7S analyzes the company at a much more intrinsic level, and it's purely qualitative. It does not rely on how well the company is doing at the moment, but whether or not the company at its core will be able to succeed with the people working in it. While this framework, it's used a lot in consulting, investors can also use it if they have enough information on the insiders and how the company operates. Though usually this information can sometimes be hard to find. A third framework we can use is called Porter's 5 Forces. It's named after a Harvard professor called Michael E. Porter. So you may have noticed that Porter's 5 Forces is very qualitative in its nature, and it does incorporate some quantitative factors such as like costs, cap requirements, and a few others, but for the most part, it is a very subjective approach. Each person who performs Porter's 5 Forces will have their own opinions about the dynamics of an industry or a company, and this goes beyond quantitative facts. So it'll be your own intuition that takes this analysis method along, and it'd be kind of difficult to argue one way or the other. So Porter's 5 Forces is not a blanket solution, obviously, for understanding a company's place in its industry, but it does not necessarily require an in-depth analysis. But that being said, the more detailed your analysis is, the better informed you'll be and the better understanding of an industry you'll receive. And it's a simple, but it's a powerful framework. As a side note, this framework can also be used to analyze industries or sectors. All right, so past these qualitative frameworks for fundamental analysis, what else can you do? So there's a bit of a preview for our next video, but you can look at the income statement, the balance sheet, and the cash flow statement to kind of just take a look at how the company is doing financially. And you can also derive a ton of ratios from the balance sheets to make calculations about the company and infer some more things. Next, we'll be going over industry analysis. So what is it? It's important in scoping out industries that will take off in the future, like electric vehicles or space flight, as we saw with the recent tests, or genomics. So industry analysis lets us find companies whose industries we know will be solid and make a somewhat safe investment toward the future. For example, food is an industry which will never go away, and as such, established food companies will make very safe long-term investments. So stuff like McDonald's, Coca-Cola's, these companies will be around forever. this is obviously not financial advice. As such, a framework and analysis method is necessary for you to figure out which industries you want to avoid and which ones you want to invest in. One of the main ways that professionals and individual investors do it is using the PESTEL framework. And this framework is a tool used to analyze and monitor the micro and macro environmental factors that may have an impact on the organization or the company in this case. So it's often used with other business tools like SWOT or Porter's 5 Forces, as mentioned before, but this will help you give a better understanding of the situation related to its internal and external factors. So as you can see on the screen, PESTEL stands for political, economical, social, technological, environmental, and legal factors. I know it's a very long name, but using these factors, you can kind of figure out which industries are in a position you feel is appropriate for your own style of investing in terms of, their social and legal standings, what technologies might be coming out of these industries, and how they affect the environment, their political standings, and so on.
All right, so we've learned a lot about how stocks work. So now we could talk about some platforms that we could actually use to trade stocks. These are called stockbrokers. So the first broker we have is a very popular stock trading app called Robinhood that you've probably already heard about. It's a relatively new app, and it's popular because it's really easy to use. You could just download the app and then make an account, and you could link your bank account and do some stuff like that, and then you could just start trading. So some of the features they offer are zero trading commissions, which means that they do not charge a fee for you to place orders to buy and sell stocks. They offer pretty much every single stock. They also have derivatives like options, which you could use. Another big feature they have is fractional shares, which means that if you don't have enough money to buy one full share of a stock, you could actually buy a fraction of a share. So you don't need a lot of money to invest. It does support some amount of margin trading, although this is a very advanced feature and it's not recommended for beginners. And Robinhood has a cryptocurrency section with a few of the more popular cryptocurrencies like Bitcoin and Ethereum. One thing that I will add is that a lot of these stockbrokers are age restricted, which means that if you want to start investing yourself with real money, you'll have to go ask for your parents' permission. Okay, so the next broker we have is TD Ameritrade, which is another popular broker that is pretty established. It also offers zero commission trading. And one thing that they have is a nice stock analysis tool that can help you with your fundamental analysis. So it'll display the P/E ratio, the earnings, and all that kind of stuff on the stock. It also supports options and OTC, which is over-the-counter trading. And TD Ameritrade has a Forex section, which you could use to trade on the foreign exchange or trading between different currencies like the US dollar and the yen. So Fidelity is another popular broker, and Fidelity is more focused on investments, hence they're called Fidelity Investments. So pretty much every single broker has zero commission trading. Fidelity also has a lot of ETFs, exchange traded funds, and mutual funds that you could invest in that will give you exposure to a wide portion of the market. Fidelity has their own fund called the Fidelity Fund, where they've picked out an index of stocks that would be pretty good for investing. And they also have dollar-based investing with fractional shares. And the last broker we have is WEBULL, which is also a relatively new platform like Robinhood. It's very technology-centered and it has a lot of cryptocurrencies. So we have the usual zero commission trading, and it has a lot more cryptocurrencies than all of these other brokers like Robinhood. So you could do extensive cryptocurrency trading there. And it also has extended hours trading, which means that you could access the pre-market and post-market hours. WEBULL does focus on technical analysis, which means that it offers charting tools for you if you are interested in that kind of things. So it could be a good platform if you are, I guess, more focused on that side. Okay, so the final section we have is the section on meme stocks, which you've definitely heard a lot about. So what are meme stocks? Well, meme stocks are stocks that gain massive popularity and go viral. They're often very hyped up on the internet. Like, I'm sure you've heard about the Wall Street Bets subreddit, where a lot of investors like came together and really hyped up this stocks like GameStop and AMC. Usually meme stocks don't necessarily have good fundamentals, so they don't necessarily have a very high intrinsic value, but they're only bought because they are very hyped up and everybody just sees them everywhere in the media. So you'll often see these drastic price increases when the stock goes up and up and up. And you'll hear about people making massive gains on these stocks, which will make them very attractive, especially to younger investors or more beginner investors who don't really know what they're doing. They could be attracted to these meme stocks, which also makes them very dangerous because they don't have very much fundamental value. Retail investing is just individuals investing with their own money. So it grew very popular during the 2019 pandemic, which also contributed to the rise of these meme stocks. So meme stock has several phases. I guess this is like kind of the life cycle of a meme stock. The first is the early adopter phase, when like a bunch of legitimate investors will invest into stock for one reason or another based on their analysis, and it'll start the initial increase in price. The second phase is the middle phase, when people who are kind of looking at the stock market as a whole will pick out some of these stocks and they'll see that these stocks are being bought a lot. So people are paying attention, will start buying into the stock also, which will cause it to increase even more. And the third is that everybody on social media will start paying attention, like saying, hey, this stock is really pumping right now, or it's going up a lot. So this is when all the media attention kicks in. So maybe you'll see it posted on Wall Street Bets or Twitter or somewhere. And then this is the FOMO phase, which is an acronym for fear of missing out. So a lot of investors will buy into the stock that's already increased in price a lot, usually way above its fundamental value, because they're fear of missing out on further gains. And then the fourth is the last phase, when everybody just starts selling the stock, because obviously a meme stock cannot keep on increasing price forever. So after a few investors begin selling, the stock price will go down, and then this causes a chain reaction, because as it goes down, more people fear that it'll dump and crash, and then so they'll start selling. And so this just causes an entire collapse of the stock. So two very well-known examples are AMC and GameStop. So AMC, it's the movie company, AMC Theaters, and obviously it was affected by the pandemic because everything had to shut down. So their share price totally tanked in 2020. And what happened was that maybe a few value investors saw that AMC could begin rising in price as things started opening up. So then the share price started increasing. Then it entered into this giant cycle where it just started to keep getting hyped up and more and more and more. And very recently, it has pumped to a really high price, somewhere around $60, and it's fallen a bit from there. So AMC is a very volatile stock that is probably overvalued and very risky investment. And then the second is GameStop, which was a bit before AMC. So what happened? Okay, so first, GameStop, the company, is a store that will sell games, physical stores that sell video games. And this is notorious for being on the forum of Wall Street Bets, where everybody made a lot of posts about the stock, and then the stock price increased due to massive amounts of people buying in. So it increased from $5 to upwards of $400 at the peak. And it's already topped out pretty much, and right now it's just around the $200 range. So the question is, should you invest in a meme stock? A lot of people who either bought in early or had the good sense to leave before the price tanked have made a lot of money on meme stocks. And this can cause beginner investors to really want to buy in these meme stocks. And buying in meme stocks could make you a lot of money, that is true, but it is also extremely risky because it's hard to tell at exactly what point the price will come crashing down. So if you choose to invest in meme stocks, one thing I will say is just be aware of your risks, be aware of what you're getting into, and be prepared to lose a lot of money.
Thank you all for watching. That was it. So today we covered some basics of fundamental analysis. We covered a bunch about different stocks. We also covered stuff about meme stocks, which I hope I don't recommend investing in them, but if you are going to, invest at your own discretion. Remember, we do not provide any financial advice. Thank you guys for listening.